Hello and welcome to DigFin VOX, Voices in Digital Finance. I'm your host, James DiBiasio. If you enjoy the program, give us a like, share, subscribe, bada bing, bada boom. My guest today is Herston Powers, partner at 1982 Ventures, a Singapore-based VC focused on fintech. I spoke with Herston about why he thinks now is the best time to be investing in young fintech startups in Southeast Asia. Herston Powers, welcome to DigFin VOX.
Thank you very much. It's an honor to be here.
So I'm excited to have this conversation. You are a next generation venture capital player in Asia focused on fintech at 1982 Ventures. So I want to talk, of course, about what's going on in the world of fintech and VC. But first, why don't you just tell us a little bit about how you got 1982 off the ground?
Sure. Yeah. So 1982 Ventures is an early stage seed fund primarily focused on fintech across Southeast Asia. And my partner and I, when we decided to launch 1982 Ventures, we saw that there was a gap in the market for investors that were ready to write that first check or institutional check for a founder to accept. And then also there was a gap in kind of sector expertise or knowledge with regards to financial services and fintech. So we kind of checked both of those boxes. So we're kind of the right GPs for that strategy. But more importantly, in Southeast Asia, it was very clear that the next 10 years in this market will be dominated by fintech, and that the true opportunity for early stage investing had to be focused on fintech because of the last 10 years were actually e-commerce, ride hailing, online gaming, online travel. And if you look at every other market in the world, financial services and fintech were where the most valuable VC-backed companies were standing. So I would say 1982 Ventures was started with a lot of luck, but more right time, right place, and we happen to be the right team to go after this opportunity.
Before you just get into that narrative, just a quick background about you and your partner.
Yeah, sure. So I'm originally from Texas. I moved to New York to study, where I was able to then go into macroeconomic research. And then I moved into banking. I was with Bank of New York Mellon for many years. And primarily my focus was helping international companies list on the New York Stock Exchange or NASDAQ. And at the time of, in my days, most of those new IPOs were actually coming from China, a lot of the tech companies. So they relocated me to Hong Kong, where I built an advisory business covering the China market very extensively, but also the entire region of Asia Pacific. The China story was very well developed. It became almost a machine. We were listing companies almost at will for a good period of time. And then we saw the same new internet or new economy companies being developed in India. So I went to India to also focus on helping those companies prepare for IPOs and get ready for potential US listings. But what happened was actually there were more green lights in Southeast Asia. We saw kind of a clearer path for some of the large tech companies. At the time, it would have been Tokopedia, the Gojek, we're now together, to actually do those listings. So they sent me here to Singapore, and I relocated about 8 years ago to launch that business, and saw some success and actually got some deals done, which was amazing to be a part of. But in the process, especially working in India and Southeast Asia, I started getting closer to the VCs, and many of them had not been through the IPO process or preparing their portfolio companies for that, where in China, everybody could do this on the weekend, right? But so I kind of started to get more ingrained in that network and really fell in love with that side of the table and what they were doing, but had not really made the decision that that's what I wanted to do. So the next step for me was actually moving to a PE fund or investments company focused on mid-market fintech companies in Southeast Asia. And on paper, it was fantastic, but we just ran into a wall where we couldn't find big enough fintech companies that were ready to be taken over, or where we could actually get majority or significant stakes. So my partner and I, we were working at the same firm at the time, just said, this strategy is great for Southeast Asia, but probably in 10 years. And right now, the opportunity is in early stage. So we were able to kind of test that strategy, get a few deals done, make a name for ourselves, and that kind of was what allowed us to launch 1982.
Okay, great. Thanks for that. So let's talk about the thesis. You guys have a thesis that there's this growth story here around fintech in Southeast Asia, and that now is the time to jump in. What is behind that? So for the past 10 years, you talk about ride hailing or Tokopedia, e-commerce, but these companies have already built in their own fintech capabilities, which is not what you had in the US, right? So, you've got GoPay as part of Gojek, et cetera. Even Carousel, Lazada, they all have some sort of payments infrastructure. So what room does this leave? I mean, yes, we've seen the rise of many interesting payment fintechs from the region. Some of them are domestic, many of them are cross-border, from remittances all the way to wholesale. But what is it feels to me like there's been a lot already in payments fintech in this space, both from fintechs and from the big platforms. So where do you see that? What's the lever for growth? Is it just the rise of digital consumerism in the region, or is there something more to it?
Yeah, no, it's a great question, because I think that's what the common misconception about fintech in Southeast Asia is that we've already accomplished fintech. We've already hit the milestones because we can use an e-wallet, and some of these great tech companies are already offering this. But if you kind of dig a little bit deeper, what we find is that none of these companies are actually leading in any of their segments, to be honest. And what we've also found is that they've struggled to create fintechs within those existing businesses, whether it's a digital bank, a buy now, pay later solution. So what we've always said is that to do fintech, you need to be extremely focused, and it probably needs to start as a fintech, because growing and scaling an e-commerce business is a lot different than starting in a regulated space like financial services and fintech. And that mindset change doesn't happen overnight at some of these large tech companies. So while these are amazing companies and have produced some great entrepreneurs that are now launching fintechs, what we find is, just like the banks, these or traditional incumbents, they have trouble really launching digital financial services or fintechs from scratch inside their own ecosystem. So what that leaves is a massive, wide open space for the right founders with the right team to either work with a lot of these companies, in many cases getting acquired by these companies, but actually to become the category leader in their space, whether it's on the lending side to consumers, to SMEs, or even just providing customers better experiences. And that's what fintech really has the opportunity to do. So we hear a lot of talk about, the bridging the financial inclusion gap, but we see also a massive opportunity in just enhancing the customer experiences for the millions of people in Southeast Asia or the businesses. And we haven't really seen that with the large incumbents on the tech side or the financial side.
You made a point there, Herston, about launching something that's native to financial services, i.e. native to all the compliance and regulation that comes with finance. A lot of fintech, a lot of tech has been really a regulatory arbitrage, often more than some creative actual innovation on the technology side, right? So would you agree with that statement, that what we've seen to date has been a lot of regulatory arbitrage? And if you're looking to build the next models, are they going to have any more success if they end up being regulated with all the costs and headaches that requires?
Yeah, no, it's a great question. So at least at 1982, we take the view that regulation is actually a positive for fintech, and we run away, or there's a big red flag when a founder tells us they can get around regulation or they don't need to think about it. That's a huge red flag for us, because it's not sustainable when you're trying to build a massive business. So in the short term, you may be able to do that, but it's not something that we like to back. We want founders that are engaging with the regulators, and I would say that Southeast Asia is in a fortunate position because many of the regulators, whether it's in Indonesia or Singapore, and increasingly even in Vietnam, you're seeing very progressive stances about the adoption of digital financial services. So we don't believe that a regulatory arbitrage is going to be a sustainable, long-standing competitive edge to launch a business. You need to be engaging with the regulators, helping them understand what you're trying to do, and at the end of the day, just make sure that customers and consumers are protected. And I believe our portfolio demonstrates that. So I guess the short answer is that I agree and disagree with that statement. For us, we want to back people that are working with the regulators.
What's the cost element of that? So how do you manage the costs with your portfolio companies? Because that's a heavy burden from day one for a slim company.
Yeah, and that's the beauty of being a software company or being a tech company, is that you don't have legacy overhead that a lot of the financial institutions have to deal with and have to maintain in many cases. So if you could kind of start from scratch and build something with those, I guess, considerations in mind, you would probably draw something a lot different than what the largest insurance company looks like, or the largest bank, or the largest security brokerage. So you're able to make better margins just through your the structure of your business. So yeah, there's always going to be costs to compliance and legal and admin. But those are good things for your business as long as you built the business that's true tech, it's true software that scales. But if you're just replicating what the banks do, then yeah, you're not going to survive.
What are the kinds of founders that you're looking for? Let's call it Fintech 2.0 if you want, or next gen Fintech in Asia. What are these founders going to be like in terms of their backgrounds, their experiences, and I guess their personal characteristics that might be different from what we would have sought in a founder 10 years ago?
That's very interesting. So at least for Southeast Asia, the conditions for an investor like myself, even despite the challenging fundraising market for many founders, have never been better. So the last 10 years, we've seen a cohort of talent that has been inside Grab or inside Gojek and Tokopedia, have seen actually how a business scales, that when it's time for them to launch their dream or their business, they're just much better equipped. Where 10 years ago, a lot of the founders in this region were just learning by doing and having to, with not a lot of mentorship in many cases. So, I mean, you have to give such a hat tip to many of the men and women that came 10 years before. But now we've got a cohort of talent that's grown up in this massive digital transformation that's happened in Southeast Asia. And when they step out, are just much better equipped from a knowledge standpoint, a technical capability standpoint. There's much more technical talent that's available, homegrown in places like Indonesia and obviously in Vietnam and the Philippines. So they're just much better equipped, and the amount of resources that they have at their disposal has grown exponentially. So now there are many more local, independent VC funds. They're the corporate VC funds that are now working much better with the ecosystem. And you have foreign investors coming to Southeast Asia, realizing that actually this is the most attractive market in the world, and it's all green lights here. So we have even more capital coming to fund some of these new founders. What their profiles look like is never the same, and we try not to pattern match around that. Sometimes it might be a seasoned entrepreneur that's built businesses in Europe, who's relocated to Singapore or Southeast Asia, sees an opportunity and launches a business. It could be the fresh graduate from Bandung University, the MIT of Indonesia, coming out and launching their dreams. Or it's someone who's come from a larger technology or even a financial services institution realizing that. So what we try to find are just people with either extreme domain expertise, or have just dug really, really deep into a specific area and solving a very specific problem. And obviously, the baseline of having grit and being able to grow a business is what we're looking for.
What kind of fintech industries or activities do you see as having the most likelihood of success or growth? Traditionally we would look at, oh, it's a payments fintech, or it's a lending tech business, some sort of matching platform, or it's insure tech, or et cetera. We go to So are you thinking along those lines, those sort of category lines as well, and have a few areas where you want to place your bets, or are you more just interested in finding the right founders, and you're less concerned about what the specific model is?
Very good question. So the founders are paramount in our decision, but generally we don't like to take quote unquote founder bets where there's not really an idea or a business model. We like to basically learn from the market, and hopefully they are able to transfer some of their earned insights into a specific space, or have seen something. So you can't take that away. But what we see from an opportunity standpoint is that the baseline or the foundation has been set, and every day that foundation is getting stronger. So we have more people transacting digitally online. We have real-time payments coming online in Indonesia. All of these developments are going to allow the next generation of founders to build better and more sophisticated fintech business models on top of that. So we actually see a huge opportunity in B2B payments and B2B payments platforms. So as much as we believe that the payments question has been solved, it really hasn't. I mean, even whether you're a multinational down to an SME in these markets, reconciling your payments, invoices, even just collecting the cash is so difficult still today, despite all of the strides that we've made. So we see a lot of opportunity in building these B2B payment operation stacks. I'd also say that embedding finance, embedding lending into other services, and even vertically into different industries, whether that's wholesalers, FMCG, logistics, there's opportunities to go very deep in some of these massive traditional businesses with a vertical SaaS play that's embedding fintech and payments and lending into those value chains. So we're definitely looking at that. I'd say something that's super topical which is a lot different for most of the world, is the rise and explosion of social commerce in these countries. Obviously, there's a lot of headlines around that, but the growth is just undeniable.
Like key opinion leaders, social, that sort of thing.
Sorry?
Live streamers. So you mean like figures on social media, live streamers, or key opinion leaders, these sorts of folks?
Yeah, exactly. Or just maybe it's a mother that's selling on Instagram on the side, right? These kinds of things.
Right. People just being savvy with their social media accounts to get attention or find ways to connect with customers.
But actually selling items, right? So not just selling ideas, but selling goods to many social media users. But there's no real fintech infrastructure around that. So we invested in a company called OrderFaz that is doing just that, helping the millions of social sellers in Indonesia transact better, more efficiently, handle the logistics and the fulfillment, and actually help them increase revenue. So if you really understand what financial services can do for traditional markets and growing markets, the opportunity, it's a wide open space. And another thing I'd like to mention is that we are finally seeing the emergence of B2B enterprise SaaS fintech platforms being built from Southeast Asia, specifically Singapore, for the world. And the companies in our portfolio that have decided to go global from day one are some of our best performing companies, with clients in the US, clients in Japan, Europe, Australia, all being built from Southeast Asia, all being built from Singapore with maybe distributed teams. And what that does, it unlocks the opportunity size for that particular company, where Singapore is a pretty small market to sell B2B SaaS. But if you're already signing clients in Japan and Europe, we've got a massive opportunity. So we're doubling down on that thesis.
Yeah, that's sort of the Israeli model, which was again from the 90s, building for day one customer. In the Israeli case, obviously the main customer was the US because of the size of the US and they had close ties. A lot of Israelis live in the US. Whereas here, it's taken Singapore a long time to get to that state. But it's amazing to see. But there's also some risks involved. Of course, there's always risk when you are investing in startups. So you mentioned social media unlocking those sellers, but then what happens? Like just this week, the Indonesian government announced that it's banning sales on social media channels. I mean, I think they're looking at TikTok, but they made it a blanket, not just for one company. So when things like that happen, that can be very disruptive to a narrow focused fintech. So how do you kind of, obviously you're in a business of bets and it's a power law bet. I assume you're not assuming every company is going to be a hit, but you want them to work. So how do you help them when they've got suddenly a surprise like that, which is kind of beyond their control?
Yeah, exactly. And that's why it's so critical for fintech founders to be um, in step with the regulatory environment, so that none of this is a surprise to them, and being closed. So my background in financial services, I've been dealing with the regulators in Asia for the past 15 years. So having that access and ability to pick up the phone to understand what's the right side of operating, or also where we should be pointing towards in the next 6 to 12 months, is invaluable for a founder, especially a young founder that may not have that access. That's where 1982 plays a key role in their development. So
But
regulatory
in
risk
this
is
in this
always.
case, though, what do you do? I mean, here you've got you described me a company that is meant to help people sell on social media in Indonesia. Now they can't. So what do you do? Can you help them
Actually,
pivot, or I mean, or do they have other businesses they could diversify into, or is there still a
no,
role here?
yeah, I hear you. This is actually a tailwind for that particular company. So they'll be able to support even more social selling through their app. And this company has grown incredibly fast since we funded it. It's actually already cash flow positive, generating six-digit revenue, it's a monthly revenue in 6 months, which is remarkable in this environment. And while this policy change is really going to impact one particular player, actually it's going to really spur even further growth for the company that we've invested in.
Okay, cool. So let's talk a little bit about the fundraising environment. You're there to support these companies, but many of them must be finding it very difficult. We're in a new interest rate environment. And then you also have to fundraise because you need to go to your LPs and convince them that you're a good bet at a time when they can just park their money in money markets and earn a cool 5%. And it's not just that LPs can say, well, I can still get maybe 8% from my VC portfolio, which is, let's face it, actually pretty ambitious. It's the risk premia has also changed. So they want even more to take that risk. It's not just sort of, a delta one kind of shift in risk taking. So what are the conversations you're having? Are you finding different types of LPs, new types of LPs that are looking to come into this space? How are you just sort of navigating your own fundraising on that side?
Oh, great question. So we actually are just preparing to launch our second fund. And we have about 20 to 25% already committed to this fund. And I would agree that the environment is very challenging in the sense that people are just taking a lot longer to make decisions. But at least for our strategy is differentiated enough that we're actually seeing a lot of traction. And because our first fund is performing relatively well, we're just under 2x in our 30 investments. We're over 50% IRR for fund one. That's giving a lot of people a lot of confidence that our strategy is the right strategy, and it's we're getting a lot of traction on the fundraising side. But it's tough. Fundraising is always a challenge, and now there's many different options of where you need to allocate. So I'd say the more experienced allocators know that they have to put something in VC and are generally pretty consistent. Maybe they take less VC investments, but they're still investing in the asset class because they know they need to be there. And most of those allocators also realize that 2023 is probably going to be a very strong vintage based on historical precedent. So I'd say the more sophisticated or experienced allocators are still investing, and they understand this is where the 10x funds will come from. Is actually they're being launched now. So that's a positive thing. I'd say in 2021, and even maybe just before that, pre-COVID, there was there was exuberance in the market where everybody wanted to be a VC. Everybody could say, "Oh, I'm raising a fund," and could probably get halfway there. You see a lot less of that. So there's a lot less tourist VCs out there. People are a bit more serious, and even the folks that maybe had invested in a fund or two, or even just invested in angel investments, kind of realize that this is a full-time job. It's not something you can do on the side. So I think people that want this exposure to this asset class, well, they'll be there. But things are taking a lot longer for sure.
Yeah. What do you see as the valuation picture looking like right now?
Yeah, for us, pretty unchanged, I'd say, because we generally are setting the price because we're the first check that the founder accepts. So we haven't been impacted too much on that front. But then the knock-on effects for the Series A and the Series B for our portfolio companies, definitely multiples have gone down. I'd say in the last 6 months, we started to see more deal activity where some of our portfolio companies started receiving those term sheets, and their Series A or Series B are actually closing, right now. So the market is changing in a positive sense. It's improving, I'd say. I think it's going to take time for the growth stage to get there, but at least at seed stage, deals are still closing. Series A has seemed to come back. People are putting term sheets down. People are getting serious with their due diligence. So ideally, we continue to see this trend happening. How long this kind of slowdown or protracted challenging environment lasts, I'm not sure. But at least we're seeing some very positive signs, at least within our own portfolio, with the downstream rounds getting closed.
And what's for your first fund? I don't know how many years you got left, but it's still a pretty recent fund. You still must have some way to go there. But are you at the point where you're talking with your founders about exit?
Well, it's funny because we get offered from other investors for liquidity. They want our position in some of these companies, even as early as Series A. Downstream investors or strategics are approaching us to get access to these companies. For us, we see a lot of room to run in these companies where we're looking for outsized returns. So that hasn't been the topic of discussion yet. We do constantly monitor our portfolio for liquidity opportunities, and at the right time, then we are able to either take some money off the table through secondary sales. I'd say in this environment, we're starting to see a lot more inbound M&A inquiries from primarily Japan, India, and the US that want to get a foothold in a market like Indonesia. We're starting to see a lot more of that coming either through us or to our founders. So it's discussions that we have. We try to work with the founders to maximize their outcome and maximize what they want to do with their business. But yeah, still early days. But the opportunity for liquidity for us has never not been an issue. We're aiming to be a 10x fund, so we got a long way to run.
Okay, just a little crystal ball. Obviously, you are as a seed investor, you're not probably going to be the one who's going to be taking these guys to IPO if that's the way they go, or to a giant strategic sale. I mean, you might still have some skin in the game, but they'll probably have some, Series B, Series C investors that will come in and probably would have outsized portion. But nonetheless, where do you just expect some of these IPOs, if they choose to go IPO at all? Where do you see that happening? Are they thinking NASDAQ when you talk to them, or are they thinking, no, maybe the Indonesia Stock Exchange, or they want to list at home, or maybe they're in Indonesia or Vietnam, but Singapore might start to look attractive to them. Just where do you see that dynamic headed for startup companies?
Yeah, I love this topic because of my history. So you might have asked this on purpose, but it really depends on where the company is focused and which market and where they're based. So what I believe is another misconception, or maybe it's not been fully realized, is that the fact that the Indonesian Stock Exchange has successfully listed at least 3 very large tech IPOs over the last 2 years has basically taken the ceiling off some of the opportunity that we've seen. So the potential upside for us has increased because of that fact. And where in those models, e-commerce is a kind of a winner take all type of scenario. In fintech and financial services, many people can win and many people can play. So I think the fact that the IDX has shown that it can accept massive tech listings is going to hopefully start a super cycle in this ecosystem where there's going to be more capital returned to investors, more founders that step out, or more talented individuals that step out of these companies once they've been able to exit and start new companies. But we're just going to see an upward growth in the capital markets for tech companies, specifically in Indonesia today. So we're very bullish on the progress of the equity capital markets there. And we see that for our portfolio in particular, that if an M&A or trade sale doesn't happen, that they have a path to listing. And we know that the next companies on the docket for the IDX happen to be in the fintech space. That's Indonesia. I think for some of the companies that are more global focused, New York will still be attractive. And we hope that Singapore becomes even more attractive for some of these companies. But from our perspective, it doesn't really change the game. The idea is you're looking for the deepest liquidity, the most market awareness and institutional knowledge for your industry, so that you can get that coverage, you can get that liquidity, and obviously where you can get the best valuation that can be sustained as well. And I think every founder will have to look at what's available. But I still believe that Indonesia is on an upward trajectory and will develop their capital markets.
Great. I think that's a great way to end our conversation today. Terrific high note. Herston, it's been a pleasure speaking with you.
Thank you very much for this opportunity, Jane.